This is the Note Closers Show, where you get the latest developments in distressed note investing and learn the secrets of how you can control millions of dollars worth of property for pennies on the dollar. Get educated and entertained by someone who has closed thousands of deals and lives to support you in achieving the same. Now, here's your host, CEO of We Close Notes, Scott Carson.
Good morning, good afternoon, good evening, everybody. Welcome to this special 2-hour event of the Note Closer Show, Monetizing the Mortgage Meltdown. I am your host, Scott Carson. Excited to be with you here for the next couple of hours. Want to encourage you all to take tons of notes on what we'll be discussing over the next 2 hours. We're going to be breaking it down basically in 3-4 sections for you, so to be digestible and be able to, for you to be able to walk away with a lot of information, knowledge, and then also action items to be able to implement what we'll be talking about today over the next few months for you to make 2021 an even better year, hopefully for many of you out there. I want to thank all of our listeners from the East Coast to the West Coast. I want to thank our international audience. I'll be thanking our individual radio stations across the country that are broadcasting this live out there to Americans across the United States here. As always, guys, honored to be with you guys and that you would take time out of your busy schedule to listen here. But I want to make sure and add value to many of your guys' lives here with our knowledge, what we've learned over the last decade of investing in distressed debt and tracking the different mortgage markets out there. It has been an interesting and very chaotic 2020 for most Americans in some sort of fashion. And the mortgagees out there who have been facing difficulties paying their mortgages after job loss and COVID and everything else that goes along with this crazy year. I honor that you guys take time here. We've got a lot of opportunity in the near future here. And if you know how to act, where to look, and what actions to take, you can really come out and really monetize what's going on when a lot of people are hurting out there. You can make a lot of lemonade out of the lemons, everybody. So if you guys don't know who I am, my name is Scott Carson. I am the CEO of WeCloseNotes.com. I am also the host of the podcast, the Note Closers Show. Podcast has been around now for just over 4 years as we record this with millions of downloads and millions of listeners each month. For the last decade plus, since the last recession took place back in 2008, my sole focus in the real estate world has been buying and selling and investing in distressed mortgages, also performing mortgages out there. And for many of you guys that are out there listening to this, guys and gals, many of you are looking to invest. Many of you are already very successful real estate investors, but who have either grown tired of fix and flips or tired of being a landlord and dealing with toilets, tenants, and trash out, or trying to find the next fix and flip that not overpriced or where you have too many weekend warriors coming overbidding you to a point where it does not make sense for you. Maybe you're in a market like Austin, Texas, or others out there where it just doesn't make sense anymore. It's really hard to make money when everything is so overpriced. So our first session today is going to be kind of about what's going on in the market. We know that over 40 million people have filed for unemployment in 2020. That number continues to increase and decrease depending on what's going on. We know that small businesses are really struggling. They're talking about that over 50% of small businesses are not going to survive into 2021. Minority businesses are going to also be hit extremely hard, with over 67% of minority small businesses failing in the upcoming year. What a crazy election time frame. No matter who you voted for and who ended up winning, all right, the world is more divided than we've ever seen before. And I really believe that it's up to us as Americans and up to us as our given right to life, liberty, and the pursuit of happiness to go out and really solve a lot of the issues out there. Our government's not going to solve issues. I think we can all realize that what goes on in DC is just for their best interest. It's not for ma and pa borrower out there across the country. It's not for those in Fort Wayne or for those in, the Emerald City in Seattle or Portland or Austin or Corpus Christi, Texas, or small towns like Ingleside, Texas, where I grew up on the coast of the Gulf of Mexico. There's a lot of opportunity all across the United States right now if you know where to look. And never have we seen an opportunity like what's going on right now, what's going to happen in 2021, based on what's happened in the past year, All we have to do is look back to a decade ago, what took place in 2008, 9, and 10 to see the opportunities that took place for the last decade. I've bought over $1 billion in distressed debt. There's going to be a huge transfer of wealth already taking place, ladies and gentlemen, out there. If you know where to look, not only in the residential side, but also in the commercial side of real estate. And that all starts with buying distressed debt. So let me share with you a little bit about what I'm talking about before I dive into a little bit of the content here for you guys. Like I said, I'm gonna break this up into about 3 to 4 parts over this next 2 hours. And I'm so excited to be doing this. This is a very special event, a 2-hour broadcast for you guys all across the country on how to really dive into what's going on in the mortgage market. So we plan to use this effectively to deliver great content for you. But like I said, I've been buying and selling distressed debt for over a decade now. I've helped thousands of Americans with money or without money dive into this amazing niche of real estate investing. No, I'm not talking about fix and flips. No, I'm not talking about buying rentals. I'm not talking about buying apartment complexes. What I'm talking about is buying the debt. And some people are like, well, how would you ever buy the debt? Why would the bank ever sell you? Oh, no, it's been taking place ever since the first mortgage was created back centuries ago. IOUs have been sold and traded and liquidated. And it's the same thing in the United States. All you got to do is go watch the movie The Big Short, one of my favorites, to understand a little bit more about what's going on in the market. But there are so many lending institutions in the country out there, not just the big banks like Bank of America, Chase, Citi, Wells Fargo. You're not going to buy mostly notes from those big guys. Those are going to be handled on Wall Street in huge tranches or trades. But that still leaves thousands of lending institutions across the country, thousands of banks that have distressed debt, residential and commercial, on their portfolio that they're looking to get rid of. All right. And so we'll talk a little bit how to find those deals. We'll talk about how to raise capital or how to fund those deals. And then we'll also talk about the exit strategies, how to make money in that. And throughout today, ladies and gentlemen, we're going to be sharing you some great resources, some amazing things that you can adapt and put into your own portfolio to really make some above average returns. But like I said, I bought over $1 billion in debt. I started off like many real estate investors back in 2002, graduated college, bought my first house a year later after landing a great job where I was on the way to making 6 figures, was laid off and was not a good time. Bought a couple investment properties prior to being laid off because we had such great credit. It was a great time here in Austin, 100% financing all 3 houses, and literally went from making good money and having 2 renters paying rent time to having them both being laid off because their employer laid them off, and also my company closing its doors and laying me off as well. So I empathize with the borrowers out there, the millions of Americans. If you think about this, currently we're sitting at about 1 out of every 10 borrowers is in default. And that's just not behind their mortgage. We're talking 1 in 10 are roughly at least 90 days behind their mortgage. That's not talking forbearance agreements. That's talking people are in distress status out there. Before everything hit the fan, ladies and gentlemen, going back to last year, 1 in 11 Americans was already 30 days behind their mortgage. Now, the media doesn't talk about that, and God knows the media, the news, social media doesn't like to talk about that. They want to keep you looking at something else. But literally, we have been on the cusp of a huge change in the markets, a huge housing crisis. Yes, real estate agents, a lot of people talk about, oh, it's a great time to buy. Most amount of homes being sold right now. That's true, but you have never had such a gap between the haves and the have-nots as far as coming to homes across America being affordable. I look at what's going on here in Austin, Texas. The median price range of the home is accelerated to over $100,000 in difference than it was a few years ago. It used to be 250 was median price. Now we're just south of 400,000 being the median home price. That doesn't leave a lot of affordability for people that come into the service industry, the people that take care of us, the rest, the bartenders, the waitresses, the janitorial staff, the housing industry staff, the people that do the things that most people don't want to do. And Austin, where I'm at, is not the first city or area to struggle with that. We've seen that taking place in bigger cities across the country: San Diego, LA, San Francisco, Denver, other parts of the East Coast, Miami, there's a lot of difference between those that have it and those that don't have it. And those that don't have the resources have been hit extremely hard here in 2020. And that just goes to lead why we're seeing such a huge amount of defaults across the country. Like I said, 1 in 11, 1 out of 10 before everything happened. And now we're seeing 1 out of 10, or at least 90 days behind, not a month behind. So when you couple that with the amount of small businesses closing, and then also on small businesses, what does that lead to? Well, that leads to, when small businesses can't pay their bills and closing, that leads to a huge wave of commercial defaults across the country taking place. And that is, I think, evident also of COVID, businesses closing, and them not having the government to delay foreclosures, give them the bailouts like that we've seen on the residential side. And with the conversations that I've been having with bank asset managers, people at banks that handle their distressed asset portfolios, that's the side of the bank that they're really worried about. You know, the big 4 banks last quarter came out and announced that they were going to have over $150 billion in losses. Bank of America having $50 billion, JP Morgan Chase $32 billion, Wells Fargo's from around $40 billion in losses. That's a lot of real estate. That's a lot of people behind the businesses, behind the real estate, behind these mortgages that are struggling to make it. And so we'll talk a little bit later on about those opportunities for you guys and how you can tap into those deals, into those banks that have this distressed threat, and importantly, tap into those out there that have the funds or the entities or companies that are interested in that type of real estate to be able to pass it through you, and you make some money either wholesaling the deal or being a partner in the big deal that's going on right now. We're, like I said, 2021 is going to be an interesting year, and as we come to the end of 2020, especially in December, it's going to get very interesting after December 15th on the residential side as we figure out what's going to happen. Are they going to delay the foreclosure moratorium and the eviction moratorium, or move that into next year and kick the can down the road, or are they going to leave it where it be and let it end and let the free-for-all begin? But like I said before, guys and gals, I've been buying distressed debt for over a decade now. I've helped thousands of real estate investors not only tap into distressed debt, but also performing notes, whether they come to the table of millions of dollars to buy for their own portfolio, or they're coming with nothing, and we show people how to raise capital from other individuals out there to how to really boost their portfolio return, to really make a name for themselves, but also change their direction of destiny, as I like to say. We've helped a lot of people change their environment, change their goals, change their generations, not only theirs, but their kids and their following kids, by helping them put together a wealth strategy in buying distressed debt or performing debt to help them get out of the rat race to really achieve some above average return. So I could not do what we're going to be talking about today without thanking a couple of our sponsors. Laughlin and Associates are celebrating their 50th year out of Reno, Nevada. Aaron Young is the CEO of them out there. If you're looking to start a corporation, looking to start an LLC, reach out to Laughlin and Associates. You can go to corpveilprotection.com and talk with them, talk with their staff. Amazing group of individuals out there to help you structure your entities the right way. I also want to give a big shout out to getfundable.com. Merrill Chandler and his whole team out there working with our clients to help them put together lines of credit on the personal and the business side to help them put capital together so that they can tap into more amazing deals. He is Merrill is the credit messiah of helping people understand what's going on in the market. And it's never been more important now to know how your FICO works and how your credit works, and how it's not all about your past. If you've had a bankruptcy or a foreclosure or a divorce or something in the past, late payments, don't worry so much about it. You can really plant your flag and move forward in the right direction. So big kudos to both Laughlin and Associates and getfundable.com for being a big sponsor of the Note Closer Show and what we do here in the last 4 years. But anyway, ladies and gentlemen, if you're an active real estate investor, welcome. If you are new to real estate investing, hey, you are in for a treat, as we're going to share how to monetize the mortgage meltdown. So we're going to take a quick little break and be right back. Hey everybody, Scott Carson here, and I am excited that you're joining me here for this 2-hour special presentation on how to monetize the mortgage meltdown. And if you are interested in getting more information, or also getting a download link of this special presentation along with some other goodies, then you're going to want to pull out your phone and text the word notes, N-O-T-E-S, that's right, N-O-T-E-S, notes, plural, notes to 474747. That's right, 47 three times. So that's the number, notes to 474747. We'll send you a link to this download so you can watch the whole thing or listen to it. Along with it, we'll send you a copy of my free book, 73 pages on how to buy real estate for 40% off or greater, how to break into the secret world of note investing. This is a best-selling book for it. Normally it's $19.99 on Amazon, but you can get it today for free. It's a great resource, a lot of great information. And I speak in layman's terms. I want everybody to walk away from hearing me speak for an hour or reading anything I offer up more educated, more knowledgeable, and being able to apply that information directly into their real estate business. Look, 2020 has been a crazy year. It's been a bust for most real estate investors. If you didn't know where to look, 2021 promises to be an even more amazing year if you've got the tools, the resources, and the knowledge to tap into this world of distressed debt investing. We've helped thousands of investors all across the country, and I understand it can be intimidating if you're coming from a spot where you've gone through a bit of a hardship. You've lost your job, lost a loved one, gone through the big D, been furloughed for a while, not knowing what the future holds for yourself. And guys and gals, tell you what it holds for you. If you'll take the action and allow me to help you coach you along the way, text the word notes to 474747, and we'll send you some resources to start off on the right path. And we look forward to seeing you all at the top. Bye. All right, everybody, welcome back. So as we dive into the first part of our special presentation about how to find these non-performing notes, how to tap into these deals, a lot of people ask, well, Scott, what is a non-performing note? For those of you guys that are listening out there and haven't heard that term. It's one of the most important questions. If you don't know what the heck I'm talking about, it's gonna be a long day. A non-performing note is a note, or in our case, mortgage, where the borrower has not paid the bank or the lender in at least 90 days. A non-performing note can be somebody who's paying, hasn't paid this month, but pays next month and skips a month or is late. That's still called a non-performing note, but they're still usually getting caught up. With what we look at with our firm, we look at portfolios of notes or mortgages where their borrower has not paid in at least 6 months. There's at least 6 months behind and struggling or distressed in some sort of fashion. Now, the borrower may have been distressed in either a job loss, sickness, the market has crashed, they've been laid off, death in the family, a variety of things can happen to cause a borrower to become distressed where they're not paying. I mean, so a lot of people had to make decisions of, do I pay for food for my family, or do I pay the mortgage? Do I keep the power on, or do I pay the bank? And what's going to happen when you're tight on funds and you don't have savings? Hey, your family comes first. There's no fault in that. I was there once years ago, back in 2004, as I hinted in our first segment. You know, you have to realize that just because somebody is unable to make their mortgage payments, this does not mean they're a bad person. This does not mean that they're a deadbeat borrower, that they're trying just to, live off of the charity. Now, don't get me wrong, we still have a portion of borrowers that are like that. You give them an inch, they take a mile. But there's a lot of people out there that got into their house as the idea of the ultimate, as they say, the American dream, buying their first house, raising their family there, their 2.5 kids plus dog and the cat with the white picket fence. That obviously, for a lot of people, has been the American dream for years. And that's how we've often gauged how our economy is working in home sales. The mortgage market has always been cranking out millions of new originations or refinances as rates increase or decrease. And we've never been at an opportune time where these rates were so low to get a mortgage right now if you can qualify. Even if you can't qualify, there's a tremendous amount of FHA, government-backed loans that will still help you get financed with the help of either down payment or minimal down payment. Over the last year, there's been a lot of banks and lending institutions taking the opportunity to even pay that down payment or pay closing costs to help Americans get into a house with virtually nothing out of pocket. But it's also those type of loans that are most heavily impacted right now, whereas FHA loans are roughly about 20% of all those originated here are in default. When you have somebody that gets into a house with no skin in the game, no down payment, or their down payment's paid plus the closing costs it's, they don't have a lot of equity. They don't have a lot of skin in the game when it comes to staying in their house. They can move on because they don't have a lot invested. And so The FHA loans have been one of the biggest, defaulted, heavily hit borrower niches or segments, I should say, not really a small niche, it's a big segment of distressed taking place in this last year. So we see a lot of defaulted mortgages from banks. And we, as an investor, as an investment company, we get these lists of notes from banks that we come back. The underlying asset is the house. Now, while we're bidding, and our main thing we're focused on is the mortgage, is that receivable, that month in, month out receivable, which obviously isn't taking place. The collateral for this loan is the house. And so we do a lot of evaluations. We look at the property value, we look at the foreclosure time frame in that state, we look at the borrower, what have they made as far as payments beforehand, what they put down, what type of correspondence they're having with the borrower. There's a lot that goes into buying a distressed note, but we also are taking over technically the bank's nightmares. As Halloween has passed us here, yes, not only are the borrowers in a negative nightmare now that they can't make their mortgage payment and they're having a hard time to choose between putting food on the table or paying ABC Bank, the banks are also in a nightmare situation because the banks are heavily penalized when they have mortgages or a default rate that goes above a specific point. For every loan that a bank has, every $100,000 loans in value costs them roughly about $1 million in fees that they can leverage, they can bring in, interest rates and other things that they're charging. There's a lot of reserves. And when you look at the way that banks leverage property, for every dollar they bring in, they're leveraged then out 15 to 50 times. So there's a lot of bad things that can happen when a bank's default rate starts to peak over 8, 9, 10%. Now, one of the things that the banks have to do on a regular basis, and we're talking federally chartered banks, they have to file a quarterly report with the FDIC, the Federal Deposit Insurance Corporation. And it's with these quarterly reports that we track about 1,700 different banks out there that have at least 5 branches or more. Why 5 branches or more versus 1 branch banks? Well, a small bank that has less than 5 branches can be very conservative on their lending practices. They're not going to go and be giving alternative lending opportunities. They're not going to be giving non-prime or subprime loans that we used to call them, or Alt-A loans. They're going to be very bread and butter, high credit scores lending, because they don't have a big amount of funding or a big amount of reserves that they can lose or tie up with bad loans. So that's why we target banks that have 5 or more branches. That's just on the banking side. There's a lot of lending institutions out there that are originating mortgages and selling those off to the government or selling those off to bigger banks out there. We'll talk about those opportunities here in a few minutes. But what I'm trying to get at here is when you look at there's 1,700 lending institutions, and you take away the top 5 or 10 banks, Bank of America, Chase, Citi, Wells Fargo, you can throw IndyMac Bank or US Bank in there too as well. That's still 1,700 plus lending institutions out there that have distressed notes on their books. And every bank on the stuff that we pull has some sort of distressed debt, whether it be on the residential side or on the commercial side. They disclose this in their quarterly reports. And so how do we find these banks out there? Well, one of the things that you could do is go to FDIC.gov every quarter and spend time trying to go through each bank's quarterly files. That's not an effective tool. That would take a while. You would get bogged down going down too many rabbit holes of looking at information. So we have a tendency to be a little bit different in how we target to find deals. One of the biggest, I should say, tools or lists that we pull is we work with a company called Bauer Financial. Now, Bauer Financial is a third-party independent rating system that evaluates banks and credit unions. And every quarter, after every bank or credit union has filed their quarterly report, the banks with the FDIC, they put together a spreadsheet that shows exactly what banks have, what they disclose. So we buy that list every quarter, and it tells us how a bank is rated. They give it a star rating, 0 to 5 stars. And it tells us how much in default, how many loans beyond 90 days are in default do this bank have, what percentage of their portfolio does it make up, how many loans, or what percentage of loans, or what dollar amount of loans they have from 30 to 89 days late. And they also break it down by residential, REOs. They also tell us what kind of multifamily loans that they have in default or distress, and the number of banks or branches that they have. This is a very valuable list. It also gives us the CEO's name and their general number to call in to the bank. Now, we would prefer to have an email address, obviously, but we do use those numbers to reach out to the right parties. Now, you're not going to call the president of the bank to buy non-performing notes, okay? You're not going to go into your local Wells Fargo or your local Chase Bank and being an ex-banker. I had people literally come into my branch, because I was an ex-VP of Chase back in the day, asking to buy notes, buying our loans. I'm like, oh no, bank, we don't do that. We don't sell. Well, Chase does sell their bank notes, their non-performing stuff, but they just do it on a much bigger scale, $50 million trade. So most, individuals like you and me aren't going to write a check for $50 million. If you do, please give me a phone call personally and we'll go shopping. What I'm trying to get at is there are some specific departments inside of each bank that handles the distressed asset sales. They also are the people that are looking at the bank's portfolio, performing and non-performing, and identifying how much they have to move off their books. They're also working with the loss mitigation side to try to get them to collect and get these non-performing loans back to re-performing. Now, you're not going to call customer service. You're not going to call even loss mitigation. Inside of each bank, there's basically two major departments. You have loss mitigation, which is the people that are handling the collections. They're handling the call outs. They're handling the short sales. They're the ones that start dialing for dollars when you become 7 days late on their mortgage. Their biggest fear is after, when they want you to get to pay within that first 7 days. If you start dragging out beyond that, you start falling closer to 30 days, you're going to see more communication, more phone calls, trying to get you back on track to pay that mortgage back as soon as possible. Because when a bank has so much in distressed debt, they have to pull money out of their lending capabilities into reserves to hold. And if you see a bank start to increase its reserves, it's getting to the point where it's got a large portfolio of distressed debt that they're looking to move off their books. All right. So keep that in mind. But the departments go by specific names inside the banks. And the four that they go by the most are, the first one is the Special Assets Department. It's the Special Assets Department. The second is the Secondary Marketing Department. Those are going to be the two biggest well-known branches, or actually job titles of the people who handle the note sales at banks across the country, usually the larger institutions, okay? Now, when you start getting into a more of a regional bank, you'll still see special assets or secondary market, but you're probably going to see the emergence of the Chief Credit Risk Officer. Usually an executive vice president for the institution is the Chief Credit Risk Officer. They're looking at the loans portfolio and the risk status of those residential or those commercial loans. Then you want to also look at whole loan traders is another name that a lot of the larger institutions have. They have specific individuals handling those whole loan sales. And you'll also see private lending institutions, private mortgage companies that aren't banks that also have whole loan traders that are trading off of their warehouse lines or trading from their portfolios to the bigger banks to recoup what they've lent out off of either their own funds, so they can go back and rinse and repeat and make the more, make those fees, make the yield spread premium. Because that's really how a bank is making money, ladies and gentlemen. If you don't know how a bank makes money, they really don't want your house. Okay, they don't want to take back a foreclosure. The banks are not in the rental business. They're not in the fix and flip business. They are in the lending business. You deposit your money in their accounts and they pay you 0.1%. All right. And what do? They go out and lend that money out at a half, at a half percent, to somebody cheap, they'll give you a 0.5% on your CD if you deposit money with them. I mean, they'll give a ridiculously low amount, but then they'll go out and lend it out at, okay, let's give you a house loan at 4%, or let's give you a car loan at 6 to 8%, or hey, let's give you a credit card that may be at 0% for 6 months, but after that, we've got you on the hook for 18%. They're arbitraging those funds, and if they're, let's just say lending they're giving to you at 1%, which we know you'd have to have $100,000 in a CD for basically quite about usually 5 years or 10 years to get 1% on your CD. If they lend that out at 6%, they're not making 5% difference. They're making 500% return on your money. Think about that. And that's why becoming the bank is such a powerful method. And that's one of the things that we look at when we're buying distressed debt. We're literally, when we're buying that debt, we're buying that mortgage at a huge discount from the bank because the borrower is not paying. We become the bank and we have a lot of options to work with the borrower. We'll get to exit strategies in a later segment, but how do we find these deals? Well, obviously we talked about banks. We also We'll talk about mortgage companies. There's a lot of lending institutions out there that have gotten back into the lending game in the last couple of years. Any type of mortgage banker you see out there, not a mortgage broker. A mortgage broker is working with lending institutions and banks trying to, pitch their loans, but mortgage bankers will often have their own, pool of money they're lending off of, or a credit card or warehouse line with a larger bank that they're lending off of. So you can find them, like we said, banks, lending institutions, mortgage bankers. You can find them by dealing with investors like you and me, note investors out there. You can find us by typing a note investor on LinkedIn. LinkedIn is a great source for finding banks and the right persons in the right departments at lending institutions across the country. It's one of the tools that we use on a regular basis to look for special asset managers, secondary marketing manager, chief credit risk officer, or whole loan trading departments. If you do a search for any of those on LinkedIn, you'll find thousands and thousands and thousands of people that you can reach out to, and they may be able to send you a list of notes to direct you in the right direction. Okay, well, that's one of our biggest prospecting tools, is utilizing LinkedIn. Now, we talked about private investors. You type in note investor on LinkedIn. You could also go to look for different note conventions or distressed debt conventions, mortgage banker associations. Every state has a mortgage banker. Texas Mortgage Banking Association, California MBA, as they call it. You can see when they meet on a monthly, quarterly, or they have a big convention annually. You often will find people coming to those annual events with the title special asset manager, secondary marketing, chief credit risk officer. So that's a great way to go as well. Now, I also like to go after looking for events in the note industry. There's some smaller events that take place on an annual basis or biannual basis, some conventions, and you can search for those note conventions, and you'll often find a lot of note investors like yours truly either attending those events or speaking at those events. And that's a great way to kind of get your feet started. You're not going to have to fund a $50 million portfolio right off the bat. And that's a question that a lot of people ask, is like, oh, I tried to get in the note business back in 2010 and I didn't have $5 million to get started and I just gave up on it. Well, I didn't have $5 million back in 2010 either, but I bought millions and millions and millions of dollars in debt in the last 10 years. There's plenty of ways to raise capital. We'll cover that in the next segment with you guys. But what I'm trying to get at more so than anything else in finding a non-performing note is you have to start hanging out differently. There is no MLS for distressed debt. There's no main website that you can find all the distressed debt in the country. You've actually got to become a Sherlock Holmes to go out and find some things. And one of the things that we like to do is we also like to look at transactions that have taken place. Now, when a note is sold, when say ABC Bank sells a note to 123 Investors LLC, when they sell a one-off note or even a portfolio, there are specific things that get recorded at the county clerk's office, all right, to handle the transfer, the county recorder's office. Just like if you're buying a house and selling a house, what gets filed? A deed, right? A deed shows transfer of ownership, okay, a warranty deed or a quick claim deed. Now, a deed isn't filed in a note sale. What is filed in a note sale is called an assignment of mortgage. That basically, what it does is it transfers the receivables of that mortgage that was originated, say, by ABC Bank to 123 Investors LLC. It transfers that payment stream, transfers the mortgage, saying, okay, I'm no longer the bank on this one. This is the new bank. This is who your new lender is. Now, people ask me all the time, like, Scott, do I need to go out and become Dodd-Frank compliant to buy distressed debts, to buy notes? And the answer to that is no. You don't have to go out and get a licensed NMLO to go and review your loan purchase, because that loan is not being rewritten. It is not a new loan. You are buying an existing loan, and you don't need to get, you're not originating the loan, which is, you would have to go get a national mortgage loan originator if you're originating a new loan, but you're buying an existing loan. So it's already Dodd-Frank compliant, specifically when you're buying from institutions. Now, there are a tremendous amount of owner finance mortgages out there. I don't chase owner finance mortgages. Nothing wrong with them. But what I've just found that I would rather fish in deeper pools, bigger oceans, bigger gulfs where there's a lot of fish to get versus trying to fish one mortgage out of thing. Now, what I mean by that, well, lenders have millions of dollars in distressed rate, sometimes thousands of individual mortgages, residential, commercial, sometimes a mix of both on their books. And if I can make contact with one bank, one institution, it often will feed me a tremendous amount of deals on an ongoing basis, every quarter, every year at least. Now, if I'm targeting owner financed notes, I'm basically going to find one note. I'm going to have to prospect. I'm going to have to do a lot of direct mail campaigns, letters or postcards, or out to these owner finance, lenders, trying to offer to buy their one note or two notes or three notes at the peak. That I'd never found to be an efficient form of prospecting. I would rather deal with the banks and the lending institutions that have deals, they're originating new deals on a regular basis, and I'm going to get a list of their stuff. Once I make right party contact with the right person at those 4 potential titles, I'm going to have an ongoing flow of deals. And you know what? I'm not spending thousands of dollars in each month to try to find one deal. I'm finding one source with with email and phone calls and LinkedIn. Those are our 3 major prospecting methods for finding deals as real estate investors focused on the niche of note investing. And I'm targeting just first liens. I'm not going after second or junior liens. I'm going after first liens on residential and commercial properties. And I'm buying in most of the major markets across the country. Now there's a few areas I don't like to buy. We'll cover those later. But that's basically my pitch there, ladies and gentlemen, when I'm reaching out on LinkedIn, sending an email. Are you the right person at the bank or lending institution that handles your note sales? I'm buying for my own portfolio. I'm buying in most major markets. And I would love to see what you have on your books either this quarter that you're looking to move. Maybe we can create a win-win for you. And that's one of the things that we do on a regular basis, once a month, sometimes twice a month, especially as we get to the 4th quarter. We're sending out email blasts to list of asset managers that we pull or that we've created or connected with off of LinkedIn, different events. We're jumping on Bauer list. We also, the Bauer financial list, to look at a list of banks' names. And by calling banks on a regular basis, we built a big relationship, a large list of relationships with different bankers out there. If you're interested in hearing us call banks, you can always go into callingbanks.com. We do this on a monthly basis. We're dialing for dollars for roughly an afternoon. Yours truly calling 30 to 50 banks in an afternoon. You can hear it. And it is a lot easier than most people realize. It's literally just having conversations with individuals like you and me and seeing what the banks have. And 95% of the time, it's extremely enjoyable. Only a few bit of the times you'll have people that are like, don't call me, or having a bad day. But that's far and few in between of what's going on. These days, banks are glad to get our phone calls, and you can hear it in their messages. You can hear it in the amount of callbacks that we get. Whereas early on last year, or even the previous year, we weren't getting a lot of phone call backs, return messages from bankers. We're getting an extremely large amount of return phone calls as the banks realize that they have to be moving stuff. So you can always check it out, callingbanks.com, and get signed up for one of those things. But what I'm trying to get at, ladies and gentlemen, is finding notes is easier than most people will make it out to be. They're not going to be asking for proof of funds. They're not going to ask you if you've got $5 million to fund. Most banks don't care. They've just, if you're talking to the right person and saying the right things, guess what? They're willing to work with you. If you know what to say, don't look like an idiot. You've got a LinkedIn profile, got a website. That's great. You've got your vendors in place. We'll talk about the vendors in place that handle most of the heavy lifting for you. You can do this business. You can make money in the national mortgage meltdown that we're seeing. And you look at whether it's residential, commercial, huge opportunities across the board. And so I'm a big advocate of this being one of the most, one of the most financially savvy niches into buying some sort of real estate investment, of being able to buy non-performing notes at huge discounts. It gives you a lot of flexibility to work with a homeowner to get it reperforming. And then once it turns into a performing note, it's basically investment cash flow on automation. Everybody, every month you're getting paid. And it's a beautiful, beautiful thing without having to deal with toilets, tenants, trash outs, without having to deal with all your other investors. You literally have an investment that returns something to you on a monthly basis versus having to go out and try to kill something every month, something that feeds you again and again, ladies and gentlemen. give you an example, breaking down a simple kind of a numbers for you. Say we're looking at a deal where a borrower owes a 125 on the $100,000 mortgage. Okay. They haven't paid in a few months. Let's just say a year. Haven't paid for all of 2020. Their monthly, let's just say the monthly interest rate is somewhere around 5 or 6%. If you say 6%, that means they're $6,000 a month roughly. Sorry, $6,000 a year in payments if it was just interest only loan. So then paid for a year, $6,000 behind. They may be 2 years behind, maybe delayed. There's a variety of things. Maybe the market value dropped a little bit because their house is only worth 100 now, maybe when it was worth 110. All right, let's just say they owe 125, house is worth 100. They haven't paid in a year. We're probably going to come in roughly around 50 cents on the dollar of the as is value. So if we pay 50 cents on the dollar on the $100,000 property that they owe 125, that means we paid $50,000 for the note. Now, if their monthly, we'll just say principal and interest payment is about $500 a month. $500, if we can get that borrower back on track with our servicing company reaching out after we buy them and say, hey, we see that you've fallen on hard times or you haven't paid in a while. I know that the other bank was wanting you to bring all your payments to the table, all year plus of your payments, plus late fees and other things to the table. We know you probably don't have that. Could you start making your $500 a month payment? Could you do that at least? That's called just reinstating the loan. We'll go through different exit strategies later on, but literally $500 a month. They can get them to start. If we can get them to start paying that $500 a month times 12 is $6,000. $6,000 divided by $50,000 is what kind of return to you, ladies and gentlemen? 6,000 divided by $50,000 purchase price. That's roughly a 12% return. Okay, that's not too bad. It's a whole lot better than the market's returning across the board. Now, let's say we get them say, listen, could you make an extra $200 a month payment? Could you bump $700? You're paying from $500 to $700 a month. And then for every $100 extra you pay, we'll forgive you $100. So we'll give you 2 for 1 and any extra 100. So they pay $700 a month. That's $8,400 in the first year. Divide that by $50,000. That's a 16.8% return on investment. That's not too bad. Yes, most borrowers can do that. Well, you don't want $6,000 in lump. No. Let's have you bring a little bit extra. Or could you bring $2,000 to the table versus $12,000? Okay. There's a lot of flexibility taking place here. But the idea is that we get them to start making payments again. We get them back to the table. And if we get them to start making payments again, after 12 months of on-time payments that's collected through a third-party servicing company like Madison Management or SN Servicing or Note Service Center, there's a whole ton of different servicing companies out there across the country that will collect payments and handle the legal stuff for you. You don't have to do it all. You should not be doing it all. That after 12 months of on-time payments, that mortgage is now considered a reperforming loan. And a reperforming loan with 12 months of on-time payments through a third-party servicer, you have increased the value of that note because the borrower is falling through other things. So it's considered reperforming. So yes, now they still may owe 125. The house still may be worth just 100, but you could probably sell that note for 85 cents of value. Okay. So if you've received, if you're selling the mortgage at roughly 85% of the value of the property, that's $85,000. So you got $8,400 in cash flow over the 12 months, plus $35,000 above the $50,000 that you paid for the note. You sold it for 85, so you made $35,000 on the note sale. That means you just netted $43,400 in a year's time frame. Divide that by that $50,000 investment. That's an 86.8% cash and cash return. What? I know. What? It's kind of crazy that way, but think about it. House is worth 100. You made your money by coming in, taking that off the bank's books. Okay. Bank takes that $50,000 that they got originally from you and they go out and they lend it out 12 times on 12 different mortgages. They rinse and repeat on a regular basis. They make up what they lost in that between that 110,000, 120,000 and the 50 they sold it for. They make it up, they write it off their books and they're good to go. You came in, stepped in, borrower still owes that 125. House is still worth 100. You bought a distressed asset. You got it at a discount because you took over the bank's nightmare. You solved an issue. Hey, I'll give you $50,000 to take over this troubled asset. We do this all the time. How many of you guys have gone and bought a shirt off the rack that was worth $100 originally, but you paid $20 for it or $50 for it on clearance? Still worth $100. It still looks nice, still fits the same as it did a month earlier. It's just that that company wanted to move it now to get off their inventory because they had to pay money for inventory. Same thing. Distressed assets pull down a bank. Okay. If they get 50 grand and they take that non-performing note off their books, they're now in a positive status. They got 50 grand and go back and lend with it they didn't have for the last year. Okay. You being the note investor, your 50 grand, whether you used it out of your IRA or savings, you bought an asset that was worth at least twice what you paid for it. You worked with a borrower, you worked with that receivable, got them back on track in a flexible way, being lenient with them. You may do a variety. Maybe drop the interest rate down after 12 months. Maybe you reduce what they owe from 125 down to 110 after a year. There's a lot of things that we do on a creative basis to work with the borrowers out there. But now you added value to that asset by now getting it back up to being a truly valued, that note being truly valued about 100 grand. Now, what does the person that paid 85 grand get for it? Well, we know the monthly P&I is 500, right, everybody? So 500 times 12 is 6 grand. 6 grand divided by 85,000. What they paid for it is a 7% cash and cash return. Somebody who's got an IRA, individual retirement account. There are also a lot of funds out there, institutions looking for performing notes at 7 to 8%. That's a pretty good win there. Win for the banks, they get it off their books. A win for the borrower, they get another hand up to do some good. A win for you because you made a phenomenal turn inside your retirement account. And it's also a win for the investor who bought the note from you looking to put their money to work and make a positive return. Now, that's a lot of information, but let's do this, guys. We're going to take a short little break and be right back as we dive into a little bit more information here in our very special 2-hour Monetizing the Mortgage Meltdown special event here. Hey, everybody, Scott Carson here, and I want to invite you out to a special one-day training event for my next Note Weekend Cliff Notes version of learning how to buy notes for huge discounts. That's right. You can join me Saturday, November 21st. Yes, that's the Saturday before Gobble Gobble, not after. I know you're going to be comatose from eating too much turkey and watching bowl games if we still got enough. But coming Saturday, November 21st, that's the third Saturday in November, join me from 9 a.m. to 5 p.m. for a full day of note knowledge. That's right. Yours truly will be teaching you the Cliff Notes version of note investing, how to find, fund, and flip non-performing notes directly from banks and asset managers for huge discounts and make money with one of our 10 different exit strategies in the note business. I've been buying distressed debt for over a decade now and have been so lucky to buy huge deals with huge discounts on residential and commercial properties. And there's a variety of different exit strategies that we'll break down on how to make money and how to turn a lot of lemons into some sweet tasting lemonade. That's right, everybody. So Saturday, November 21st, 9 to 5, all day with yours truly. Take a few breaks here and there. It is recorded, so if you've got to step away for a little bit, you can catch the replays. But one of the big things is I'll give over $1,000. That's right, over $1,000 in bonuses for you to sign up. Now, this is a really awesome offer for you guys. It's $49. If you go to noteweekend.com, get signed up there. It's $49. Includes the replays, includes a list of over 1,700 banks, and it tells you exactly what they have as far as percentage in default, how much of the percentage of their portfolios looking bad, how much in residential debt they have in default. And it's just an opportunity for you guys to learn the note business. Kind of a dip your toe in the water, teaser aspect. It's like I said, my students call it the Cliff Notes version as we go through the basics of how to find, fund, and flip non-performing notes. So you can go to noteweekend.com and get signed up there for as little as $49, or you can be alerted to, and I can shoot you a text message with the direct link. If you're busy driving or watching on your phone, you can text the word notes, N-O-T-E-S, text the word notes, N-O-T-E-S to 474747. That's right, 47 3 times. Text the word notes, and we'll send you a link to the workshop where you can get signed up today. And that's good for you, plus your spouse or partner, friend. That if you're a real estate investor wanting to learn how to tap into this huge mortgage meltdown, this is to be the starting point for you to learn. No BS, no smoke blowing up your skirt or shorts or whatever you're wearing for the day. Real content, real actionable items. And as people say, we pack our classes with more content, It's like drinking from a fire hydrant for the day. So it'll help you get those bowels right and jowls ready to rock and roll for Thanksgiving feast here the Thursday afterwards. So it's Saturday, November 21st, 9 a.m. to 5 p.m. That's Central Standard Time. And we will look forward to seeing you there, guys, and taking action and seeing you all at the top, everybody. Bye. All right, we're back from our short little break there. I want to give a big shout out to a lot of our listeners out there across the country, but we could not do what we do and get the work we do without our huge network of radio stations. So big shout out to those of you guys that are listening on this in Tampa on either AM 1030 or on FM 92.1. Same thing goes for those that are listening in the villages in Florida at 97.7 FM. Those of us in Jacksonville at 90.3 FM. And those of our loyal listeners in Newport Richey on 88.3 FM. Big shout out to all of our Florida listeners, our family. And then also same thing goes out across the country to those in Long Beach on FM 101.5. To those of you guys that are in Boulder, Colorado on 96.3 FM. Those in Colorado Springs at 87.9 FM. Big shout to you guys that are in Colorado and California out there. Be amiss not to mention those of you guys that are in Georgia, in Macon on 870 AM or 87.9 FM. Those of our listeners in Las Vegas on FM 99.5 or AM 1520. Our listeners, we don't forget about you guys in Lancaster, PA, who are listening on 1640 AM and 102.1 FM. And then our loyal friends in Pittsburgh on 94.7 FM and Milwaukee on 90.3 FM. So thank you to guys, to all of our radio stations and our loyal listeners all across the country. Could not do what we do without you guys listening on a regular basis. So thank you. If you're in one of those areas, hey, make sure that you text the word NOTES, NOTES, to 474747, and we'll make sure and get you a copy of our book, and you'll also get a replay of this. So if in case you got to step off and go do something this evening, you can't listen to the full 2 hours, we'll make sure and get you a link to the recording and go back and watch it at your own pace. So that's NOTES, NOTES, to 474747. All right, last segment, we kind of wrapped up going through a bit of a case study, kind of showing you numbers, showing you a little bit how profitable it can be, how truly when you buy a distressed note, it can be a win-win-win-win across the board. Now, what happens if the borrower doesn't pay? Well, if the borrower doesn't pay, then you go the route of foreclosing, the legal route, going through a foreclosure, selling the asset off, keeping it or taking the property back, and then you can do what you want to it. Selling at the foreclosure auction, 80, 90 cents on the dollar, still yielding a pretty good return on investment. Taking the property back, if you want to increase your rental portfolio and turn it around, well, you can. If you want to fix it up and sell it at a higher price because you do some repairs to it, hey, guess what? You can do that. There's a lot of different exit strategies. We'll go through those 10 exit strategies on the next segment. But right now, I want to talk about the thing that a lot of people are probably thinking about listening today, and that's the money side of the things. And you're sitting there as you're driving or sitting at home or working out, whatever you might be doing as you're watching or listening to this. Like, well, Scott, I don't have a 50 grand myself to buy that one-off note. I don't have $5 million. I don't have any money. I'm broke, or I'm barely getting by my 9 to 5, and I'm in the rat race and can't get out. Help me, please, help me. Well, what you have to realize, ladies and gentlemen, I was in that same space over 10 years ago. I was an investor here in Austin, Texas, buying some rentals, doing some light fix and flips, doing some wholesaling, making some money like many investors are. I said I had all the tools in my tool belt. And then I found the note space. Well, I found the note space after everything hit the fan in 2000. I left the mortgage company that I started with a buddy of mine, and we're traveling the country, doing a lot of originations, meeting a lot of great investors. And when the music stopped, it didn't stop on an extended period of time. It stopped overnight. So I was like many people out there. I'd gone through a divorce, starting to financially hurt, didn't have money. On my last two fix and flip project, I actually had to send a check at closing, not get a check at closing. That's not the right place to be at on the closing table, where you're selling the property and you owe money at the thing. That's not a good place to be. So I started doing like I recommend a lot of people let me try to find deals. Now, one of the things that I've been doing well as a real estate investor is everywhere I went, those little, 2-inch or 3-inch by 4-inch things that we get at events, and those things called business cards, or going to REI clubs or networking events or conferences. You get a lot of these, but what is most people do? They put them in a shoebox. Mine was a Nike Air shoebox, orange. I put all those business cards in. Now I did one step more than most people do. Before I took it out of my wallet or out of my coat pocket or out of my pant pocket and throw it in this on my dresser or in my shoebox, I took the time to write down the information on that card, the person's name, phone number, email address, and where they're located. Now, Austin's a pretty competitive market where I'm at. Lucky for me, I was traveling the country doing mortgages all across the country. So I met a lot of people from around this great state, or this great country we have, from California to Florida, from New York to Seattle to Washington State or wherever, Chicago. There were a lot of events that I had a good fortune to go to. And I know there's a lot of real estate investors or people listening to this, they travel to conventions, or we miss traveling to conventions is what I should say these days. Everything being virtual, we all miss that interaction. But I took everybody's information off every card I got, and I put it in a spreadsheet, and I put it into some sort of email service provider. MailChimp was my first love, I guess you could say. I put their contact in there, and then I sent an email out to them after. I'm like, hey, it was nice meeting you at REI Expo. It was nice meeting you in Chicago. It was nice meeting you in LA. Let's stay in touch. And I did really good when I was doing that as a new real estate investor in the mortgage business, because it came in very handy in 2008. I didn't have any money, but I did have some assets. And by assets, I meant assets in previous history, wins and strikeouts in deal flow and case studies. I also had a win in a database. And then I had the biggest pot of gold sitting in my hands. And that was my bank phone calls. That was the asset manager list that I was building. And as I said before, I was contacting different banks, lending institutions to finding lists, and then finding deals. They would send me these lists, these spreadsheets, these PDF pages with all these lists of assets. I mean, Capital One sent me a list one time that was 33 pages deep with all their sub-$1 million loan balances all across the country, and all the assets, they can all fit on these 33-page PDF. All the assets were like in 6-point font. I had to take like a magnifying glass to read some of this stuff, okay? But I knew that there was a wealth. It was $1 million list. And that's what I did. I started, when the banks will send you a list, this is what they do. The list is the magic, ladies and gentlemen. He who has the gold makes the rules. You'll often hear when they talk about financing real estate deals. Well, the gold isn't the money. The gold isn't the funding. In today's world, where real estate investors would slice their grandmother's throat for a 4-cap, or people in San Diego, other places are scrambling because 50 grand won't even buy them a doghouse. The pot of gold is the deal. The pot of gold is the asset that's distressed or deeply discounted that you control. And so that's what I started doing. I started evaluating deals as if I had money. I would make an offering to the bank. The banks will give you 2 weeks, 30 days, 45 days. Sometimes they'll get 90 days due diligence period. I was like, if I can get 30 days due diligence period and get an approval, I can raise the capital if the deal makes sense. And that's what I did. I started evaluating the deals. I didn't worry about the money. I would make an offering. We would work back and forth. The minute that the bank would approve my offering, I would immediately start marketing that deal. Now, where did I market to is what you're probably asking. Where do you find investors? Well, if you're in a position where you don't know any real estate investors, you're in the wrong circle. You have to expand your circle. That means getting out, networking, going to real estate investment clubs, or jumping on virtual real estate club meetings and talking, or networking groups, or looking on Facebook groups, or joining LinkedIn groups, or looking, by all means, going on LinkedIn, typing in real estate investor to find other investors. Real Estate Investors Ohio, Real Estate Investors Columbus. Those were some things that I did initially. Like if I had a deal in Indianapolis, a 300-unit apartment complex that I got under contract from Banco Popular for like 35 cents of value. It was occupied, needs some work. But we got it under contract for $1 million. It was worth about $3 million. All right. And I just did that. Started looking apartment investors or real estate investors in Indianapolis. And then I started reaching out, hey, if you know anybody knows looking for a 300-unit apartment complex, I've got a great deal, an operating one that the bank is willing to let go, that they've taken back, or that it's a note on a non-performing note for Banco Popular, but we could pick it up so cheap that the return was like an 18-19 cap, based on the fact it was about a 6% loan, and we're buying it at roughly 33 cents on the dollar. if we reinstated with that borrower, it would be an 18% cap rate just to get them to reinstate and start talking or start paying back on time again. So I started finding these amazing deals, and I started using a thing called my phone or Facebook to share the details of the deals, not the addresses. I didn't want people going around by say, hey, I have this deal in Tampa, this deal in Indianapolis, this deal in Detroit, this deal in Jacksonville, this deal in San Diego. And I would start sharing these deals across social media, and my phone started to ring. Okay. Now that's a great way if you've got a social media profile and you're not scared to market. Now, some of you I know are scared of your own shadow. Okay. It was Halloween. Some of you are still scared. Okay. Some of you are still scared of the boogeyman when it comes to posting. So I get that. All right. Now, how do you find investors that have money that want to lend it to you? Well, first of all, like we said, you got to find a deal. It all starts with a deal, ladies and gentlemen. These people that talk about go raise the capital first, that's okay. But most of the time, investors aren't going to write a check unless you've got something of substance, something to interest them. Okay. They want to look at the menu. They don't want to see what the menu think is going to be. They want to actually see the deals or the stake that they're going to sink their teeth into. Okay. So one of the great ways to raise capital is if you're in an area, and most of the places that we mentioned, most of you guys are listening to this or watching to this, not only do they have a real estate investment club, there's often a self-directed IRA custodian or trustee who holds events that you can meet with, they can go network with. I could rattle off, there's like 50 different self-directed IRA custodians across the country. And most of them, so maybe some of the newer ones, but most of them, depending on where they're located, are hosting weekly, if not monthly events for you to come network. And that's a great way to go tap into investors. Go tap into, if you're in California, go tap into UDirect or IRA Trust Services out there when they have their monthly or quarterly meetings, networking events, and going and networking with other people, talking with people, talk with the staff there. Hey, I've got a deal. Who should I be talking with? Who's here at this event? Oftentimes, that's one of the best things to do is to make friends with the staff, and they can tell you who's got money, and they can tell you how much, but they say, hey, go talk to this person, go talk to that person. That's a great way to work the room. If you're scared or you're in a rural area that can't make it out because of either family or other things, you're busy working late, you always have what I call the 7 p.m. to 2 a.m. hustle. Now, for many of you that are working full-time, you may not have the opportunity, like I said, to travel to conferences or to go to these networking events because you're stuck in transit or you've got a family you got to get home to. And I get that. I respect that. You still can connect with these investors in a variety of ways. And the beautiful thing, like we talked about in the second segment about how an asset is transferred via an assignment of mortgage, all right, at the county clerk, you can do the same thing. Now, people that have a truly self-directed IRA where they've taken money and rolled it over from their 401k or an old IRA and moved it into a self-directed IRA account, say with Equity Trust, which is the nation's largest, or Quest Trust Company, or Pensco Trust, or Newview IRA, if you're in Southwest Florida, Mid-Atlantic, if you're in the Baltimore, Maryland area. If somebody has a self-directed IRA and they use their self-directed IRA to fund the purchase of a piece of real estate, they actually buy a rental property, buy a property that they can't touch that property based on IRS rules, okay? They can't go out and fix it. They can't go out and property manage. They have to do it on a passive investment aspect of thing, but hiring third-party people to handle that. That's a beautiful thing for us investors, us note investors, because if you go on the county appraisal districts at any county, you can go to a website called Netra Online. It's a free website. Most of these county appraisal districts out there are free to get online, and a mass majority of them will let you search by owner's name. Now, there's a few, like California does not allow you to let you search by owner's name on the county appraisal district. Now, why the appraisal districts? Well, that will show you who's basically the owners of properties, and they do the appraisals every year. So if you go on to the appraisal district websites, okay, and type in the name of these 50 self-directed IRA custodians, you can just do self-directed IRA custodians, searching for that in Google, give you a whole list. If you go type in Equity Trust or type in Quest Trust Company, if somebody in that county has bought a property with their self-directed IRA account, it should pop up and say Equity Trust for the benefit of Scott Carson IRA 1, 2, 3, 4, 5, 6, 7. Quest Trust Company for the benefit of IRA 1, 2, 3, 6, 7, whatever it might be. Some people will put their name, other people it would just be their IRA number. It's a win either way, provided when you look at the next line down, it says mail-in address, that the mail-in address is not the corporate office for the IRA company. Now you'll need to check that out yourselves, but literally in minutes, I'm going to give a big shout out to one of our new students, Jennifer Green, who's just north of me here in Bell County. And Bell County is around where Crawford, if you remember, George Bush had a ranch in Crawford, Texas. That's basically around where Bell County is, between Killeen, Fort Hood area, Temple, and Austin, Texas. Bell County is. Even a small county like that, she's living there. She's working on a project. She's like, how do I find local investors? And so we jumped on Bell County, the appraisal district. We typed in equity trust. We found 14 people in that county alone with their names, their mailing addresses being their direct mailing address, and the property address. So if the mailing address shows a corporate office, just mail the letter to the actual property address and say, homeowner or whatever. Now, some people will, Scott, well, how do you communicate? You send a letter. Is it soliciting? Is that illegal? No, it's not illegal. Because the way we teach people is like, listen, reach out to them, tell them you're a fellow investor, looking to connect with other investors and want to know if they're looking for more deals. And the obvious answer to this is yes. Okay. They're looking for deals. There's also two obvious yeses that you may not know of. One, the fact that, hey, they have a self-directed IRA and they used it, puts them in an upper echelon. They know some advanced strategies. Okay. That's good. The third thing is they have pulled the trigger on an investment already because they funded it. So that tells you another thing. They pulled the trigger and they have money to invest. Now, they may have used all their money in that one, but they probably have other savings, other retirement accounts, other funding in other places that you can tap into. So it's a beautiful way to find investors all across the county, the country, in your backyard or the backyard of that property or that note that you're buying. And that's just one facet of it. Jumping on the county appraisal districts, like I said, with Jennifer Green, we found like 28, 30, maybe it was closer to 30. We just did a search for Quest and Equity Trust. We found over 30 IRA investors in the county that she could mail to or reach out to. Two of them, she even recognized the name. Now, that's just on the county appraisal districts. Now, one of the other facets on how to find investors who have pulled the trigger, pardon the phrase, we are in Texas here. This works just about everywhere in the country. This works everywhere, okay, is the county recorder's office of where they file the deeds and the transfers and the assignment of mortgages. You can jump on that website as well, the county recorder's office for every county, and do the same name search. Search for Equity Trust, search for Quest, search for NewView, search for Mid-Atlantic, search for IRA Custodian, search for a whole variety of them out there, and do a deed search. This is an important thing, a deed search or an assignment search. A deed search is going to be the easiest thing, where somebody with an IRA is lent money to somebody to go buy a piece of property. There was a deed of trust that's putting that IRA's name as the collateral on that, is basically being the lender. That's the first way. An assignment of mortgage, if you do a search, you can see if somebody has bought a mortgage with their IRA, and that can be a great way to find it. So I search both deeds and assignments by looking for the same self-directed IRA. Because I'll also do just a flat assignment search. And this also goes back to the second section we just came back from the break from a few minutes ago on finding institutions that have sold mortgages and the assignments have been filed. So the county records, Netra Online, NETR online.com, free to go use. It gives you direct access to all the websites. Now, some of the websites will still charge you or ask you to sign in. I think Detroit charges you $1. Columbus, whatever, I think it's Franklin County, will let you be a guest for 24 hours, once every 24 hours. But a lot of them will let you log in, do quick search pulls, and go from there. But that's one of the most valuable ways that we raise capital, is by reaching out, pulling these lists, identifying IRA investors in counties across the country that we are either living in or buying assets in. And then we direct market to them with letters, postcards. We'll send case studies. We'll invite them, encourage them to pick up the phone and give us a phone call. We'll record a short 20-minute video that we'll upload to YouTube talking about what we do as an investment company or who we are. We'll share our team of vendors, our servicing companies, our attorneys, our realtors, and our team, showing them know that, hey, it's just not me, or it's me and my team. And many of you out there are like, wow, that sounds awesome. Direct mail only has about a 4% response rate. That's normal if you're just mass marketing thousands and thousands of people. But the beautiful thing is, like I said before, you've identified 3 or 4 things that you have in common or that you're looking for from pulling the county records, that these are investors, They have money to invest. They're looking for deals. And the beautiful thing about notes is it's passive. And they've pulled the trigger before, as we talked about. So 4 things. If you hit those hot buttons, hey, did you buy this asset with your IRA for an investment? I'd love to talk with you. Here's some case studies that we have done. I would encourage you, let's jump on a phone. We don't talk about, hey, we want to borrow your money at 10% or 2%. No, there's a whole process for it. And I encourage you to check out some of our videos on YouTube and some of our Note Night in America webinars that we do just about every Monday night. You can go to notenightinamerica.com and register for that. You can go to weclosenotes.tv. That'll take you directly to our YouTube channel with over 1,200 videos on there for you to watch, including a bunch of podcast episodes where we talk about this. We interview people on raising capital the right way, and what you should and should not do to protect your assets. But raising capital, funding these deals, there is trillions of dollars in retirement funds sitting out there that need to be invested. And there's plenty of people that have a CD, as I say, certificate of disappointment, or they have a 401k that's now a 101k, or it's now an X 401k that now is being rolled into an IRA that they need to do something. And it's never been easier to raise capital than it is right now, with 401ks being down, returns on, the stock market might be doing well, but not everybody's investing properly in the stock market. And a lot of people have lost money, or people have been laid off and out, or forbearance or furloughed, that they need to do something. And the fourth quarter and the first quarter are always the best times here, because that's when people are looking at their annual statements and realizing they did pretty good or they did pretty bad. And that's what you don't want to be dealing with, is people who are, well, you do want to deal with people that have had not the greatest year. Okay. That can lead to an opportunity to show you, hey, how can I show, if I could show you an above average return on investment, hey, let's talk. So big thing I would tell you guys is to pull these lists, send a letter out to them, talk with them, just get them on the phone. Hey, are you an investor looking for deals? I've got deals. I'm looking through some deals. I'd love to partner up in some sort of fashion, either on a passive aspect with you, where I'm paying you a quarterly return better than what you're making in your certificate of disappointment. If I could show you double to triple what you're making in your CD, would it be something you'd be excited about for a short term? And that's yes. People would say yes. Now, most people, when they hear mortgages, invest in mortgages, they think of what? How many years? 30 years, ladies and gentlemen. They think of 30 years to invest. That's not the case. We're talking short-term investment here of 24 to 36 months. Not 5 years like they'd have to tie it up in a CD, okay? Not 7 years like an annuity. We're talking short-term, 2 to 3 years, 24 to 36 months to tie it up to get an above-average return on an asset that you're picking up at well below market value. And that's one of the great things. There's 5 key elements that you can share with your private investors. One, that you're buying only first liens. That the only thing that really can wipe you out is taxes. So you double check your property tax. We'll talk more about that later on. Due diligence, that's one thing you're checking on, due diligence, making sure your taxes haven't wiped you out, but making sure you're buying below value, right? Buying first liens. You're using professionals, attorneys, servicing companies to do most of the heavy lifting, the foreclosures, the borrower outreach. You're not the person having to do that, okay? Fourth thing, you're checking, like we said, title work in the collateral file, the loan documents, because that's really what you're buying is the collateral, the loan documents that allows you to foreclose on the property if they don't pay, okay? And fifth is that you're putting insurance in case of an act of God. And then also putting insurance on if the borrower doesn't put their own property insurance, because remember, you're buying the note. The borrower still owns the property. So you still have to make sure that they're paying their taxes and they've got paying their interest. Now, if they don't do those, you do have the right to start the foreclosure process and go from there. But those 5 things, I'll repeat them one more time for you. You're buying first liens only. You're buying well below value, well below 70% or below, okay? Using professionals to do all the heavy lifting and the legal and the servicing side, right? You're checking title and the loan documents, making sure it's enforceable for you to foreclose and take the property back. And fifthly, in case of an act of God, you're making sure there's insurance on the property. Those 5 things are going to protect you. They're going to protect your investors' money. And if you're buying right, we talk about, and you're using professionals, the people that do the things that you're supposed to do. The biggest mistake we see a lot of investors is they think they're going to try to do it all. They want to work out with the homeowners. They don't want to pay the money to foreclose because they think you're reperforming. No offense, ladies and gentlemen, if you're not foreclosing in 90 days from the time you're buying the mortgage, if the borrower does not raise their hand or try to work something out with you, then you're doing a disservice not only to you, your portfolio, but your investors' money. So start that foreclosure process in 90 days if it's not already started. If you're buying it out that the foreclosure process already started, guess what? You step into that bank's shoes. You take over those attorneys that already started the foreclosure process and you finish along the way. You don't have to restart. You continue the process and get rocking and rolling. But finding notes, ladies and gentlemen, finding funding. Yeah, if you've got capital, you can use your own funds. Yes, if you've got an IRA account, you can use your own IRA account to fund deals. Yes, if you have a 401k from an old company, you can roll that into a self-directed IRA company and then be able to use that money. The biggest mistake, the biggest lie I'm going to tell you out there is that companies like Charles Schwab and AG Edwards and any of your retirement accounts, they do tell you that they have self-directed IRA accounts, that you can self-direct what you invest in as long as it's the funds that they offer. They're not going to allow you to go, oh, hey, I'm going to take 50 grand of this and go buy this property. Oh, no, that's not in our portfolio. So you can't use it. You'd have to transfer the money out. So keep that in mind. It's one thing you have to do. It's well worth it, putting the money to work. But there are $7 trillion really in retirement funds sitting out there. Only a small bit of it is in retirement accounts, but it is like shooting fish in a barrel. You have all, if you know where to look and network with people and know how to talk and share, not only the fact that maybe you're brand new, that's fine, but you have a team, you have a network, you have relationships with your vendors, your servicing company, your attorney, the insurance guys. That's one of the biggest things that I think a lot of people struggle with. Like, well, I haven't done it myself. I need to use my own money to go prove concept. That's such a bunch of horse crap. That's like saying, well, before I'm a realtor, I have to go out and sell my own house to become a realtor. That doesn't make any sense. No investment around for decades. They made some movies about it. Okay. You can take other people's money, put it to work. The paperwork is pretty simple, pretty easy to do. And whether it's a passive relationship or it's a split joint venture aspect of things, there's different ways to, as they say, skin the proverbial cat, but there's a lot of money sitting out there waiting for you to give them a phone call, waiting for you to reach out to them with an opportunity, because you, as I said, ladies and gentlemen, have the pot of gold at the end of that rainbow, and they're looking for that pot of gold. He who has the gold makes the rules. And so in today's world, you have the right, if you've got an amazing deal and you know how to market, to be able to negotiate your money costs down to single digits, not 12%, not 10%, but below that, because most Americans, most investors that have their money sitting in an account, if they're not using it, making something is a whole lot better than making a whole 100% of nothing. So keep that in mind, that you have the pot of gold, you have the deal flow, you have the opportunities, and don't ever forget that as a real estate investor out there. So we're going to take a short little break as we come back and talk about our third phase and on the different exit strategies when it comes to note investing. But like I said, everybody, if you can't stay for the whole thing, make sure you text the word notes, N-O-T-E-S. That's N-O-T-E-S, notes, plural, capital, lowercase, doesn't matter. Text it to the number 474747. That's 47 3 times. And we'll make sure and send you a link to the whole episode, along with a link to download my book, How to Buy Real Estate at 40% Off or Greater, and How to Break into the Secret World of Note Investing. But we'll take a short break and be right back. Hey everybody, Scott Carson here, and I'm excited that you're joining me here for this 2-hour special presentation on how to monetize the mortgage meltdown. And if you are interested in getting more information or also getting a download link of this special presentation along with some other goodies, then you're going to want to pull out your phone and text the word notes, N-O-T-E-S, that's right, N-O-T-E-S, notes, plural, notes to 474747. That's right, 47 3 times. So that's the number, notes to 474747. We'll send you a link to this download so you can watch the whole thing or listen to it. Along with it, we'll send you a copy of my free book, 73 pages on how to buy real estate for 40% off or greater, how to break into the secret world of note investing. This is a best-selling book for it. Normally it's $19.99 on Amazon, but you can get it today for free. It's a great resource, a lot of great information. And I speak in layman's terms. I want everybody to walk away from hearing me speak for an hour or reading anything I offer up more educated, more knowledgeable, and being able to apply that information directly into their real estate business. Look, 2020 has been a crazy year. It's been a bust for most real estate investors. If you didn't know where to look, 2021 promises to be an even more amazing year if you've got the tools, the resources, and the knowledge to tap into this world of distressed debt investing. We've helped thousands of investors all across the country, and I understand it can be intimidating if you're coming from a spot where you've gone through a bit of a hardship. You've lost your job, lost a loved one, gone through the big D, been furloughed for a while, not knowing what the future holds for yourself. And guys and gals, Tell you what it holds for you. If you'll take the action and allow me to help you coach you along the way, text the word notes to 474747, and we'll send you some resources to start off on the right path. And we look forward to seeing you all at the top. Bye. All right, everybody, we're back from our short break. I wanted to remind you all that you'd like to learn more about what we're doing and how to tap into it. We're learning a bit more than just in this. You can always go to weclosenotes.com. That's our main website. You'll find a list of all our training opportunities available from our one-day Note Weekend training that you can get signed up at noteweekend.com, to our 3-day workshop called Note Buying for Dummies, all the way up to our one-on-one coaching program we offer up with investors across the country. Check it out at weclosenotes.com. And if you'd like to schedule a quick phone call with me, you can do so by going to talkwithscottcarson.com and scheduling 30 minutes on my schedule. It's open to anybody. I always love hearing from our listeners, from our investors across the country. But if you go to talkwithscottcarson.com and pick out a 30 minutes time slot and mention that you heard me here, I might have a special gift for you. But literally, talkwithscottcarson.com and register your 30-minute phone call. Check out weclosenotes.com for all of our educational classes and opportunities for you guys to tap into to expand your note investing knowledge. So, transitioning here, we talked on the last couple sessions, we talked about finding non-performing notes. We talked about the opportunity. We talked about funding, how to find funders to fund our deals, whether you've got capital or you don't have capital. And then this session, we're going to talk about the opportunities on flipping. There's a third F, as I like to call it, the ways that you make money as a note investor. Now, whether you're investing in residential or commercial real estate, your biggest goal as a note investor is to stay a note investor. The biggest issue that we see with people is they come into the note space and treating it like fix and flipping, or they treat it like, oh, I'm going to be another landlord. The biggest mistake I made my first 2 years as a note investor was doing just that. Like, oh, I want to foreclose on everything because I wanted to own the real estate. That was a big learning experience for me. If I had been smart and listened to others, I don't want you to make that same mistake that I made. But if you buy distressed notes or buying owner occupied, which have more exit strategy, we'll talk about that in a second, and somebody wants to stay in the house and they're willing to do a loan mod or a payment plan that makes sense, do that. Say yes to yes. All right, ladies and gentlemen, you'll make a lot more money by keeping them in the house, by then taking the payments in. And then if you want to retain it for payments, great. If you want to sell the note off as reperforming and double down, take your profits and go buy 2 or 3 more, great. The biggest mistake, like I said, I made is I said no to reinstatements or trial payment plans. I went the foreclosure route. Then I was forking out cash each month, each quarter for attorney fees. And then I had to rehab the property at the end and sell back up when I could have had a cash flowing asset within the first 90 days instead of a year. So do yourself a favor, embrace becoming the bank. A lot less work. Nobody ever called the bank when little Johnny flushed down his rubber ducky down the toilet and a sea of sewage started spewing over the toilet. They don't call Bank of America. They don't call Chase. That's why they don't call the bank, but they do call the landlord. They do call the property owner to get that done. And that's one of the big differences, I think, out there. But anyway, going back into the different ways that we make money. We talked a little bit about on the first case study of talking about, hey, let's get a bar back on track. And I'm just going to kind of approach this session about what your servicing company and the vendors that you use, how they approach the bar, because you should not be the person talking to the borrowers, okay? In most states, to be a debt collector or to receive payments, you have to be licensed. Now, unless you want to go out and take all these licensing education classes or things like that to make sure you're Consumer Finance Protection Bureau compliant or Fair Debt Reporting Actions compliant, you should just hand it off, delegate the borrower outreach to your servicing companies. The servicing companies will do this on a regular basis. They usually have different price points. If it's a performing note, guess what? A monkey could collect mortgage payments on performing notes. It's the non-performing stuff that you have to take a look at, of either full service, full collections, where they're doing all the outreach, all the borrower outreach, or if it's just where you're just boarding a loan and have a third party. Maybe you have an independent counsel, maybe you have a special servicing company or special servicing attorney relationship where they're doing all the borrower outreach on your behalf. That's a different thing. But literally, for around $90 a month per note, your servicing company can handle all the heavy lifting for you in reaching out to the borrowers. And the first thing that they're going to do once you buy a note and that note is servicing transferred from the seller's servicing company to yours, that could take 2 weeks to 45 days in a lot of cases. It could take about 30 to 45 days for the actual physical collateral file. Actually, the true loan docs show up. Now, before that, when you're looking at your due diligence, there's a whole lot of due diligence we'll talk about if we have time to. If not, I encourage you to check out some more training. You're looking at electronic copies or PDF scan copies during your due diligence. But after servicing is transferred, the servicing companies will start reaching out to make right party contact, or RPC is lingo in the industry. And their biggest goal is to get the borrower on the phone and get them talking. Hey, can you start making your existing payment? Can you reinstate the loan and start paying the loan as called for on time? That's exit strategy number one. Okay. Now, if they can't reinstate the loan, second strategy is, well, could you do a trial payment plan? Or what do we need to modify the loan arrangement for in some sort of fashion until you can get back on track? And usually trial payment plans will be scheduled for 6 to 12 months. It'll ask the borrower in some sort of fashion, can you bring a little bit from what you're behind onto the table and some skin in the game? And the thing, keep in mind here, ladies and gentlemen, if a borrower isn't going to bring any skin in the game, or they're not going to start paying anything extra, you're likely, the likelihood to keep them on time and back reperforming is very low. Not a good day. The more you can get, whether it's a couple months of extra payments or a lump sum, that means that's a beautiful thing. And they're more likely to stay because now they've got some investment in the deal. Okay. So right party contact, try to get them reinstate. Second thing, we'll try to do a loan mod or a trial payment plan. A trial payment plan always comes first. If you do a loan modification, it becomes not only a taxable event because it's a short-term capital gains at that point, but once you modify the loan, if the borrower reneges and does not follow through, you can't go back after what you've forgiven. I mean, so let's say in our case study we talked about before, the borrower owes 125. If you agree to modify the loan and drop it down to 110 or 100, if they stop paying, you can't go back after that extra 20 to 15K you just forgave. You got to go after the only 1/10 at that point, and the interest rate stays the same, stuff like that. Now you can get creative in however you want to help the borrower out and reduce the interest rates, reducing or increasing terms. Some people have stretched things out to 40 years. I saw a note that was stretched out to 50 years the other day. You can do interest-only payments, full P&I. You can do pick-a-pay, payment options. There's a whole variety of things that you can get creative. Making it a payment, forgive a payment. We do a lot of that. All right, or drop the interest. You make for 12 months of on-time payments, we'll drop the interest rate down in half. It all depends on what you paid for the note and how you can get creative with it. So that would be the strategy number two if they can't reinstate the loan, some sort of payment plan or modification. Now, if that doesn't work, the third strategy is to ask if they have somebody that can take over the loan, can come over and assume the payment. Somebody can come in and take payments over from them. Maybe they're an elderly borrower, so maybe they've got a daughter or a niece or a nephew, or maybe they've got parents that can help out, or uncles, aunts, friends, somebody interested in taking over the payments. Maybe they sell their house with owner financing included, where they can take over the payment subject to. That's an opportunity. Now, somebody would ask me, well, Scott, I don't think loans were assumable anymore. Well, yes and no. You're the bank guy. All right. You're the bank. You can make a lot of the changes provided the borrower agrees to them. All right. So that's the beautiful thing. You can choose to allow them to have somebody come in and assume the payments. Now, yes, all loans were assumable prior to 1975. And then after that, it was just the VA loans. You're the bank, ladies and gentlemen. You can either get upset that somebody's making the payments, and it's a lot of people worry about and taking over subject to deals with it's the due on sale clause, or you can allow it. I would rather allow it and have a borrower who's happy to live in the house, who wants to pay to stay. Okay. So that would be exit strategy number 3 in the assumption aspect of things. Now they can't do that. Okay. Can we short sale the property? Do they owe more on their property? That would be a short sale. You as the bank have the right to allow them to sell the property below what the value or what they owe, the payoff. So you, the bank, are taking the short, even though you paid less than what the balance was. So that's a beautiful thing. Most short sales can take 6 to 9 months. With us, we approve them in 30 days. It's not a bad thing. If the borrower's interested in selling the property, that's a beautiful thing. If we find out during our due diligence period that the borrower had the property listed for sale before, we know that they're willing to walk away. Okay, so a short sale would be the next strategy. Now, if they don't have a short sale, I should throw on here too, if they've got a cash, we're willing not only let them sell the property, but if they have some cash in a 401k, an IRA, retirement account, family members, started kicks, whatever it might be, we're willing to allow the borrower to do a short payoff to take the property back to. All right. We're willing to allow them to settle for a percentage and give up some equity if it's above what we paid, if it's a good enough return. Yes. So a payoff, besides a short sale, a short payoff or a payoff is exit strategy number 5. Now, let's say that doesn't happen. They can't pay. We can't sell the property. And then we'll do what's called a deed in lieu of foreclosure, or cash for keys. Jingle, jingle, cash for keys, ladies and gentlemen. That's where the borrower on a deed in lieu, they sign the property over to us and they walk away. The deed in lieu of us foreclosing. We basically give the they return the property to us and they leave. You have to be very careful in a deed in lieu that there's not other liens, second mortgages on the property that are now going to fall into a first lien position if you forgive that debt. And if there is a second lien on the property, then you would do what's called a consent to judgment. With it helps you speed up the foreclosure process to wipe out that second lien, to remove that second lien. So consent, and you can do cash for consent. I've given cash for consent of judgment. I've done cash for keys anywhere from 500 to 10 grand before on different note deals across the country. All right. So let's do a quick recap of where we're at. Reinstatement. Okay. Trial payment, plan modification. Right? A loan assumption, a short payoff, a short sale, deed in lieu, cash or keys, or cash or deed and consent. Okay. Now that's 6 strategies so far. What's the next one? Well, the next one is foreclose. If they can't come through and do a payoff, they can't come through and take sell the property, can't come to and do a loan mod or anything like that, then we got to go the legal route and go the foreclosure route. All right. Now, the thing about foreclosures, every state has a different time frame. Yes, you need an attorney in each state that you're buying into foreclose on. Now, some attorneys are duly licensed in a couple states. You see that in the Midwest and Southwest and other places like that, or the East, Southeast. That's okay. But yes, a foreclosure process can take anywhere from 21 days here in Texas for like $1,000 all the way up to like 2 to 3 years in New York for like 10 grand. So you have to keep that in mind. I don't buy in New York and New Jersey just because of those long foreclosure timeframes. I'm not afraid of buying in Illinois, excluding Chicago. And that's a whole nother episode, a whole nother thing to talk about why I'm not a big fan of Chirac. Okay. Or Crook County, as I like to say. Horrible to foreclose there, especially if you're an out-of-state investor. All right. So you go to legal route. What do you do with the foreclosure? Sometimes it can be fast. Sometimes, we think there's deals that they'll modify or reinstate that turn into foreclosures. There's also foreclosures that we take over. Like I said, if the previous seller started foreclosure process and it's along the way, we take it over. Sometimes the borrowers that come back in, they just need a fresh look on things that we're willing to modify. We're willing to stay in their house if it makes sense. All right. Foreclosure, we don't like doing that, but it still happens about 50% of the time. If the borrower is not working with it, especially if it's a vacant property. If it's a vacant property, it reduces your exit strategies dramatically. You don't have the right you're not going to reinstate somebody who's not living in the house. Usually not going to have a loan assumption if somebody's vacant. And the big thing about vacant property, you really need to go and secure the property, protect your investment, especially as we're in the winter seasons and getting into the cold time of year. If you're in an area that freezes, the last thing you want is an indoor ice skating rink or indoor ice feature. Okay. Not what you want. And also vacant properties will often have a higher vandalism rate and also have a higher rate of repairs when you buy it, because often the air conditioner is going to have walked off. Somebody was stolen that. Copper may have been ripped out of the property, as we say, the copper goblins. And just, not taking care of the property. You probably have to replace the plumbing, foundation, air conditioning, wiring, sometimes a roof, because people just aren't taking care of the property. And that's why I like buying occupied assets, because not only does it give you more strategies for exit deals and working with somebody to keep them in the house, they're also at least maintaining the house most of the times. That doesn't mean you don't run into the occasional hoarder. Or the one deal we bought where it was a bank vice president with Bank of America, and we moved in and they hadn't had the water on some time, and they were using 5-gallon Home Depot buckets as their toilet. Okay. And that was they wouldn't get off the couch. They literally had it's a disgusting story. And I don't want to have you vomit, but occupied assets, more strategies, usually higher returns to reinstate the loan. Now, if they don't foreclose and you don't want to go through the foreclosure process, you do have the right to sell that note to somebody else. And this happens quite often. A lot of big funds will buy portfolios of notes. They'll send out letters to the borrower saying, hey, you're approved for a modification or a trial payment plan. Let's keep you in the property. Let's do something. And the borrowers that respond in 90 days, they get moved into one of those programs. But those that don't respond, the fund then immediately starts marketing that note for sale. They know that the borrower's not responded. They know it's not going to really turn into a loan mod. They look to sell that note at a 5 to 10, sometimes greater markup, depending on what the deal can hold. And if you can make 10% in a quarter, that's like a 40% cash and cash return when you are recycling your money, or so we like to say the velocity of capital. Okay. So you'll have the strategy to get them to reinstate, modify. If they won't work with us, we don't want to own, we don't want to go through the foreclosure process. We don't want to do, let's pass that buck down to somebody else who's local. So reselling the note is an opportunity. Now, here's another thing. We know that there are so many people out there who have fallen in love with the strategy of wholesaling. All right. Where they don't have to buy the asset. They don't have to come up with money. They just can kind of push paper around. Okay. And you can wholesale notes as well as a strategy for you. That means, but a property or a note or a tape under contract, and then you sell that contract off for a percentage, for a flat fee. I've had wholesaling fees anywhere be from 500 to 100 grand before. Okay. I've sold portfolios. They'll just give me a 3% of whatever was funded on non-performing. On performing notes, 1% of the funded amount is kind of a normal thing out there, because performing notes will sell at a higher percentage. You can't jack on 20% on it. But wholesaling, you can wholesale notes just like you can traditional real estate. The biggest thing about wholesaling, ladies and gentlemen, you have to be a good marketer. You got to have a list of people and know what people are looking for. And if you know what people are looking for and you have a list, instead of wholesaling and just passing and making a small percentage of capital, why not just convert those people by saying, listen, instead of me selling you this deal, why don't you fund the deal and we go splitsies? You know, why don't I pay you? You're used to making 10, 12% money. Why don't I pay you 10%? And I do all the heavy lifting. Help me expand as an investor. Okay. So wholesaling is an opportunity. You could do that. I usually talk about that being the first strategy, but I wanted that to be kind of the last strategy here for you guys. So let's do a quick recap one more time. Buying the note, you try to, the borrower is trying to persuade it to become back on track by reinstating the loan from the servicer. So reinstatement, loan mod, trial payment plan is number 2. Okay. 3, assumption, a loan assumption. Let somebody come in and assume the loan. 4, could be a short sale. 5, could be a payoff. 6, what would 6 be? That's foreclosure. 7, could be selling the note to somebody else. Did I miss? 8 could be wholesaling the note. And then 9 is if, like we talked about this beforehand, if you take down the note, get it reperforming after 6 or 12 months of seasoning and on-time payments, you can resell that note as a reperforming note again. And so that's the beautiful thing, ladies and gentlemen. You still have to, there's so many different ways for this deal to work. Every deal is kind of like a choose your own adventure when it comes to which way is the deal going to go. Are they going to go are they going to go reperforming? Are they going to reinstate? Are we going to have to do a short sale? Are we going to have to foreclose, deed in lieu, cash for keys? The biggest thing I would tell you out there as a note investor is don't fall in love with just one strategy, because you're going to end up getting burned. And if you try to dive into and just be focused on one strategy, some of the most profitable deals, you'll be blinded to potential of reinstating that loan and holding it for cash flow. Or if you try to go a different route, you know what, you're going to miss some of the most obvious strategies. And then at the end, it's going to end up costing you more than you end up making, because you're not flexible, you're not agile, mobile, and non-hostile when it comes to working with your borrowers. Give your borrowers a chance, ladies and gentlemen. If it makes sense to reinstate, if it makes sense to modify that loan, and you bought that bought that distressed mortgage at a big discount, do America a favor. A foreclosure not only can really be damaging for 7 years to that borrower, a foreclosure is also very damaging to the neighborhoods, to the cities, to the borrowers around it. A foreclosure will reduce property values in an area 10, 15, 20%, when as a loan modification keeps the values high. It keeps property values up, because a foreclosure never reduces the value in a distressed sale. And when you pull comps, hey, you have to take in consideration distressed sales in the area. So if you can, do a deed loan, do a cash for keys. We can't simply go on the foreclosure route. I know it depends on what the borrower does, but sometimes you got to get creative. And this is why a third party, your servicing company or an attorney, is the person that needs to be contacting and talking with your borrowers out there, because, hey, the last thing you want to do is talk to you and then talk to your servicer, talk to the attorney, and they can work you against each other. Keep the lines of communication very small, but very focused. They've got to go through the servicer, and then the servicer goes through you, or the attorney reports back to you with what the borrower's talking about, and then you can pick your options. And that's the beautiful thing. You're not giving up any type of exit strategy by having your servicer or attorney talk with the borrowers. You dictate to them what you want to see happen, or the options that you're willing to offer up the borrower. And that's the important thing there, that they work for you, you don't work for them. So many strategies, so many different ways is to make money in the note business if you know exactly what you're doing with or without your own funds. The biggest mistake I see people that have funds is they use their own money and they don't start marketing. They don't start reaching out, building a list of people, and they run out of their own funds, and then they're sitting there 6 months behind or a year behind, and they're watching good deals go past them because they didn't develop the skills of raising capital and marketing and taking things to the next level. So big important thing there, everybody, is many ways to make money in the note business. And the beautiful thing is it's not always about taking the real estate back. It's often, many times, and the majority of times, of doing something good to make America great again, one defaulted borrower at a time. We're gonna take a short break and be right back. Hey everybody, Scott Carson here, and I want to invite you out to a special one-day training event for my next Note Weekend Cliff Notes version of learning how to buy notes for huge discounts. That's right, you can join me Saturday, November 21st. Yes, that's the Saturday before Gobble Gobble, not after. I know you're gonna be comatose from eating too much turkey and watching bowl games if we still got enough. But coming Saturday, November 21st, that's the third Saturday in November, join me from 9 a.m. to 5 p.m. for a full day of note knowledge. That's right, yours truly will be teaching you the Cliff Notes version of note investing, how to find, fund, and flip non-performing notes directly from banks and asset managers for huge discounts and make money with one of our 10 different exit strategies in the note business. I've been buying distressed debt for over a decade now and have been so lucky to buy huge deals with huge discounts on residential commercial properties. And there's a variety of different exit strategies that we'll break down on how to make money and how to turn a lot of lemons into some sweet tasted lemonade. That's right, everybody. So Saturday, November 21st, 9 to 5, all day with yours truly. Take a few breaks here and there. It is recorded, so if you've got to step away for a little bit, you can catch the replays. But one of the big things is I'll give over $1,000. That's right, over $1,000 in bonuses for you to sign up. Now, this is a really awesome offer for you guys. It's $49. If you go to noteweekend.com, get signed up there, it's $49. Includes the replays, includes a list of over 1,700 banks, and it tells you exactly what they have as far as percentage in default, how much of the percentage of their portfolios looking bad, how much in residential debt they have in default. And it's just an opportunity for you guys to learn the note business. Kind of a dip your toe in the water, teaser aspect. It's like I said, my students call it the Cliff Notes version as we go through the basics of how to find, fund, and flip non-performing notes. So you can go to noteweekend.com and get signed up there for as little as $49, or you can be alerted to, and I can shoot you a text message with the direct link. If you're busy driving or watching on your phone, you can text the word notes, N-O-T-E-S, text the word notes, N-O-T-E-S to 474747. That's right, 47 3 times. Text the word notes, and we'll send you a link to the workshop where you can get signed up today. And that's good for you, plus your spouse or partner, friend. If you're a real estate investor wanting to learn how to tap into this huge mortgage meltdown, this is to be the starting point for you to learn. No BS, no smoke blowing up your skirt or shorts or whatever you're wearing for the day. Real content, real actionable items. And as people say, we pack our classes with more content. It's like drinking from a fire hydrant for the day. So it'll help you get those bowels ready and jowls ready to rock and roll for Thanksgiving feast here the Thursday afterwards. So it's Saturday, November 21st, 9 a.m. to 5 p.m. That's Central Standard Time. And we will look forward to seeing you there, guys, and taking action and seeing you all at the top, everybody. Bye. All right, we're back from our short little break, everybody. And I know I've covered a lot of information on kind of talking about the amount of distressed debt on the very part. We have so much. If you look at the numbers that we talked about or the Bauer financial list that we pull on a regular basis, the amount of distressed debt from this quarter to last quarter increased by over $45 billion. That's a lot of debt. I mean, it went from 85 billion to over 130 billion in distressed debt, not just people that are behind by 30 to 89 days, but people that are beyond 90 days in their residential commercial mortgage. We talked about how to find these deals from banks by easy jumping on LinkedIn or using the Buyer Financial List, or checking out FDIC.gov list for the quarterly reports. There's a whole variety of ways to find deals out there that these banks can send you their list of non-performing notes every month or every quarter they have. And I'll tell you right now, it's going to be interesting to see what happens. It comes December 16th or December 15th if things get extended out there. If it extends, if they decide to extend the foreclosure delay and kick the can down into 2021, it's going to increase defaults across the board and make the second half of 2021 really, I'd say, a bloodbath in foreclosures, not only on the residential side, but the foreclosure side. We're talking so much more debt besides just the government insured loans that have been ceased for foreclosure or the evictions delayed out there. Investors will be looking to offload their property if they're in a non-government insured loan. And then you look at the commercial side of things, who knows what happens if we have a second spike and they start to close things down. A lot of commercial property is going to be available relatively cheap. You just got to reach out to the banks. We talked about the ways to find investors by either jumping in online events and networking, or once your area opens up networking, or going to the county records and harvesting data from the county appraisal districts or the county recorder's office, county clerk's office, on people that have used their IRA to either buy a property at the appraisal district or to lend out of their IRA that the deeds have been filed at the county recorders. Great way to find them. And of course, reaching out with a letter, seeing if they're investors, just talking, starting the conversation, and having kind of your, I guess, like as I like to say, your pitch book available about what you do, why you're special, who your team is, and why you can. It's important that they talk to you because you hold the gold. Remember that, guys and gals. You hold the gold, and he who owns the gold makes the rules. And the rules are, hey, if you're a borrower, guess what? If you're buying that note, you've got a lot of flexibility in our third session about the different exit strategies that you can offer them. Remember, anywhere from a trial payment plan or reinstatement to short sales, to short payoffs, to assumptions, to foreclosures, to cash for keys, to selling that loan off to somebody, to wholesaling it if you don't want to actually buy the asset. So a variety of different strategies for you to tap into. But for most of you out there, it takes more than listening to an hour-long podcast or 2-hour-long special session. There's a lot of ways and a lot of things that go in to developing a profitable plan when it comes to monetizing the mortgage meltdown, whether it's the residential or commercial market. I could not do what I've done the last 10 years without an amazing team of vendors behind me. We talked a little bit about this and some of the things that you put in place that you share with your investors to protect you. Remember the five key points that you're buying assets below 70% of value. Well, you need realtors to make sure that whatever you bid on is below 70% of value, that you have a true valuation of what that property is that you're bidding the note off of. And so you need realtors in every city, not every state you invest in, but every city. You need them to be your eyes and ears for the local properties. And a lot of times we've had really great realtors that have become our, I have to say this, but our GC, they've managed, if we had to foreclose and do some light flips. But the more times I'm having to do flips or rehabs on the property, if I've had to foreclose, really it slows me down of what my bread and butter is, of getting them reinstated, getting them reperforming and rocking and rolling, okay? Second thing, we talked about servicing and having somebody reach out to you. You need a good servicing company. And I'll tell you this, every servicing company has its advantages and its disadvantages. Some are great at everything for the most part, and others, everybody still has struggles with some sort. And it depends what's going on. What's going on with the loan. It may not be them at all. They may be waiting on the previous servicer to transfer things over to you. So don't keep that in mind. Your servicer is one of the most important things to help you out with the day in, day out activities. And like I said, they work for you. So you share with your servicer what you're trying to do, what you want to accomplish with those assets or the notes that you're buying, and they'll work their best to help make that happen for you. So servicing, realtors, attorneys, you're going to need attorneys for foreclosures or special servicing. That's an important aspect of it. You can find attorneys by going to legalleague100.com. That's legalleague100.com. Or you can inquire with your servicing company. Or, as I like doing, reaching out to my fellow note investors and say, hey, who's got an attorney in such and such area that can help me out with? All right. Word of mouth advertising and word of mouth referrals is one of the most important lifebloods of this business in the distressed debt space. So very important for you to do that. And then you also need your auxiliary loans, the title, the title companies for you to pull O&E insurance or ownership and encumbrances reports, or previous lenders. Pro Title USA is a company we use to do that. You need BPO companies. If you can't find a realtor to do it for you on the front end, you need some a company you can go to. You need property preservation companies that go in if it's during the winter to protect your investment so that the pipes don't freeze, and you have an indoor skating rink. There's a lot of little things that you need to do along the way that just comes with experience and understanding and being able to network with other note investors to help you when you need help to reach out to. And that's why I encourage everybody that's listening on here to go over and check out our private Facebook group called Note Nation. It's a private Facebook group, right about 1,000 quality note investors for you to ask questions, for you to network, pick the brains, and be a great part to help you find people and vendors or realtors or other note investors to drive by your property, take some photos for you. But if it's the Facebook group, Note Nation, private group, ask to join. I'll ask you to fill out some questions there for you and then be part, but it's no cost. But I encourage you to connect with other note investors all across the country, wherever you're listening to us, whether it's in Tampa or Long Beach, Milwaukee, Vegas, Boulder, Macon, Lancaster, Quantico, North Florida, or South Florida, all the way to, Washington State. There are investors all across this great land that are here to help you out. We've all got started by just buying our first. Don't get rocking and rolling. If you need help raising capital, guys, there's nothing better than working with other investors out there to really create a win-win scenario. One of the next things I want to tell you guys here before we wrap it up for the day is, what's the next step for many of you? If you find note investing interesting, like I said, text the word notes, NOTES, to 474747. We'll send you a text message with a link to be able to download our book. You'll also be able to connect with us online. And I also encourage you to check out our educational plans. A great starting point for many people is to take our one-day note weekend training class. We host this class just about monthly, the third Saturday of the month from 9 to 5. It's always live with yours truly, going through the as I say, the nuts and bolts or Cliff Notes version of note investing. We'll show you how to find, fund, and flip, do a lot more deeper dive than we did on here, but it's a great way for you to dive into. And you know what? It's totally affordable for every type of budget for you guys. You get the replays, and for $49, you can really start on your journey and start taking that first step down that path towards note investing success for you by going to noteweekend.com, getting registered there. It's noteweekend.com, and it's a great place to start and start honing your craft, reading books. I always encourage you to check out the Note Closer Show podcast. That's our podcast that we're now celebrating our 4-year anniversary on. Over 600 episodes, over 1 million downloads. We also, if you prefer video versus audio, it is anywhere that you listen to podcasts, but we also have our YouTube channel where every episode is recorded via video. And so you can go back and watch that at weclosenotes.tv. I also encourage you to connect and sign up for our next Monday night Note Night in America webinar by going to notenightinamerica.com and getting registered there. Those are free on Monday nights, and it's great information as we talk about a variety of subjects when it comes to note investing. We talk about vendors, talk about strategies, finding deals, due diligence, all sorts of relevant topics for your note business. But I will tell you this, ladies and gentlemen, there's never been a better time to dive into note investing these days. Yes, it's different. There's not a glamorous reality TV show, which we all know reality is not reality. All right. There's no HG flip this note, although that might not be a bad idea. There's a lot of great resources out there, but ladies and gentlemen, it takes you pulling the trigger and taking action more than anything else. And yes, it takes a little bit of work. It takes time to email asset managers or to call banks and evaluate lists of portfolios and talking with other investors and raising capital. Any good thing, though, ladies and gentlemen, takes work. And the best time to buy a home or buy a note was 30 years ago, and then today. We're all going to be in real estate in some sort of fashion, whether you're owning your own home or your own rental property, or you're actively investing. Unless this whole economy changes where we are not able to have capitalism involved in us being able to buy real estate and invest in real estate these days, we're all in this for the long haul. So it's in your best interest to start taking action and honing your skills and learning real world strategies that work in today's market, not something that worked 5, 10, 15 years ago. It's the 21st century, ladies and gentlemen. Most of our marketing is done online. The only little bit of direct mail campaigns that we do is to other IRA investors. But other than that, our prospecting is all done electronically with a free LinkedIn account and email blasts. And if you know how to dial for dollars and you follow some scripts, you can make this thing happen. You can be the next note investor. You can replace your income. And that's one of the most important things that I tell people: start with the end in mind and what your why is. If your why is to retire your spouse, retire yourself from a job that you hate, or put your kids through school, or to retire your parents, or just to live a better life, you can do it. You just have to be focused. You have to have a plan of action. You got to be coachable, and you got to be willing to pivot. And those real estate investors who have gotten stagnant and lazy by focusing on just one strategy over and over again without pivoting to what's going on in the market, those are the ones that are facing extinction like the dinosaurs. Those are the investors that are probably griping about that. I can't find any deals. Oh, I can't find anything. When we all know there's $148 billion or 148 billion reasons for you to dive into the note business these days. Yes, it's not like going to your local foreclosure auction. Yes, you're not going to jump on the MLS and find a distressed note. You got to be creative, but anything worthwhile takes work. And if you do a little bit more, you're going to stand out from the crowd and find deals, because most people, unfortunately, are inherently lazy. Yes, there are some websites you can go to like PaperStack or Madison Management or Watermark Exchange or some other websites out there that do have some notes available for you to cherry pick from. You can look at, but they're picked over. And anywhere where it's low hanging fruit, those deals take more due diligence to find something that makes sense. And I would rather deal direct from the source, direct from banks, and get a ton of lists that most people aren't seeing. And that's what we see, is that we see deals at bigger discounts. We see deals 6 to 12 months ahead of your foreclosure hoppers, your fix and flippers. And we see them at a bigger discount than you would buying off the MLS and facing stiff competition like all the other weekend warriors that want to be the next Chip and Joanna Gaines or the next HGTV or anything like that out there. So kudos to those people. There's nothing wrong with that. I just think you need and deserve something better. I believe that you deserve to be able to achieve big goals in your lives, in your dreams, by becoming the bank, by literally stepping out and really building a cash flow, a residual income real estate business where you don't have to worry about paint, carpet, tile, some contractor showing up 3 hours late and waiting for the right price. You can dictate terms by becoming the bank and doing amazing things out there. And I encourage you all, check out our website, weclosenotes.com. I encourage you to check out all the resources available at our website. Once again, text the word notes, NOTES to 4747, 47. That's 47 3 times. Get a copy of my book. We'll download it to you, send it to you. And as always, guys, if you'd like to schedule a call with yours truly, you can do so. Go to talkwithscottcarson.com. Schedule a 30-minute phone call with me, and I'd love to hear from you. Talk with you about where you're at, where you're wanting to go, and what I think the next step is, and the logical path on your road to your dreams is available for you. So go out, take some action, everybody. Please, please, please. The worst thing you can do is not take action. If you're worried about making a decision, the worst thing you do is just sit there and not take action, because at some point, the decision is going to be made for you. Whether you are the one that are making that decision or somebody else is going to make the decision for you. I would rather be in charge of my own destiny, my own actions, and my own success path. So it is not hard to do this, ladies and gentlemen. We have a lot of our students, a lot of our investors are going out there. They're buying 10, 20, 30 deals their first year, 40, 50, 100 their second year, replacing their 6-figure salaries and doing it from wherever they want to be, whether it's at home, hiking through the Appalachians, cruise shipping across the Mediterranean, or visiting Europe and having fun there. We've got students who've closed deals all across this wonderful rock we call Earth. So go out, take some action, everybody. I look forward to connecting with you. Hopefully we'll see you at one of our upcoming workshops. And one of the things I want to leave you guys with, you can monetize the mortgage meltdown if you are coachable and you take action today. Go out and be that action taker. Be that 5% that makes a big difference, not only in your own community, but the surrounding communities out there, by making America great again, one defaulted bar at a time. And until then, guys and gals, we'll see you all at the top. Bye.